Good morning, everyone. Happy Monday. And here we are set for this market to make new all-time highs. Unbelievably so, but certainly looks like that's what's coming. Hey, Alex, Peter. All right, so markets advanced last week, right? And this doesn't really show the whole gap because it's a 24-hour chart, but there was last week's price action. There's a gap up from the prior week, never looked back, breaking a prior day's low. As mentioned here, this is what we do every day is whatever happens, our first line in the sand is the prior day's low, resistance to prior day's high. We look at where major support is, minor support, resistance, so on and so forth, and then look at the price action that occurs between those reference points. So the correction that started at the end of February, right here, chopping around for 4 or 5 weeks, appears to be over based on the price action and the breakout of this consolidation that's been going on. And maybe the SPY chart better depicts that. So you can see where the momentum stalled, the little doji type of bar, open and closes the same. The attempt to drop the big red bar, and the 180 reversal back up, the topping tail ignored, the green bar, bullish price action at resistance. During that time, we don't know that it's not going to drop down to the next level or reverse back up again. But bar by bar analysis changes our bias, meaning, so on the way up, we see momentum stall and we see a big red bar. Technical analysis 101 says it's going to go down. And again, we don't know it's not going to, but our first reference point within this time frame is the prior bar's low, and it never broke it. And it reversed right back up again. And it's like, look at that. Even after a run like that. And so then we went chopping sideways for about a month, and last week gap up, and Friday able to push higher. So use Thursday's low as at least a secondary line in the sand beyond Friday's low. A close below Friday's low wouldn't be the most terrible thing. Probably somewhat expected, or expected, maybe not the right word, but not surprising to see that happen after a gap up and a run like this. But a close under Thursday's low certainly would open up the door to a bias of potentially filling that unfilled gap down there. That would be a relatively deep retracement, but let's see what happens. Right now they're down a little bit, but not a big deal. You can see the 24-hour chart right there, and the gapping down, and maybe this is creating some support as it's retesting that pivot low right there. So as always, we'll see what happens after the market opens and whether this holds or goes down to the next level or takes out this high and off to the races. Higher time frame says it's going to go higher to here, and to assume new all-time highs, I think is reasonable considering the consolidation. And this is just starting a move from there. Whether it can get higher than that level and hit 300, well, we'll see later in the week. Earnings are going to start coming in. I think JP Morgan's at the end of this week. So you got financials, one of the financials, big ones that are going to report. And there's some others you can check the typical sites as to what's coming out. Qs look pretty much the same, not exactly the same kind of choppy. They've been stronger, showing relative strength. And one of the things I wrote about in the letter this weekend was, after a run like this, sometimes what was showing relative strength weakens to the point of not a failure, but maybe it's not going to go up at the same rate as it was before, where ones that have underperformed begin to outperform. And so looking at energy, you can look at different ETFs, showed strength on Friday, and coming out of their even longer consolidation is suggestive that they could go up. And different ETFs have different reference points. So you got the 200 lurking up above at $69. You've got some resistance up there, but we had this conversation last week with other things about resting periods and then a reference point above versus big moves up and then hitting some reference point. So energy looks like it should be able to push higher. And let's take a look at oil, which is actually up. Not much, but it was able to get above its 200, get through the next whole number of 62, had a great day on Friday, and all of that suggesting it should go higher, which supports a view or bias that energy stocks should play catch up and go higher. Russell, been weaker, but playing catch up. And this didn't break out of this little consolidation, but if you're a connect the dot trader with trend lines, well, now you're looking at a downtrend line broken, which really doesn't mean anything because it's right up into the next resistance area here. And well, it did get above a red bar, but we don't need the lines to know that. So there's that pivot high, 3 lower highs to the left and right. So we got a reference point there to get above. This pattern suggests that it should be able to do that. Right? You got a choppy downward sloping consolidation after a strong move. And this is your continuation pattern that says it should keep going higher. So we'll see. It's up at resistance, likely to stall. Today may be a stall day. Markets are down here a little bit. Maybe they want to see some earnings coming out, to regain. I shouldn't even say regain. I mean, I don't think their confidence, just based on the price action that we've seen, ever waned too much, other than waiting to buy on some type of corrective action that, this all started when our internal gauges reached a bearish extreme. And rather than pulling back, let's say a lot amount, they chopped sideways or downward sloping chop, which is what happened on the Russell. And to the same extent, the transports, but they were able to just marginally clear that swing high there. So they were stronger, and they don't move much pre-market and actually not doing anything here, but, stronger than the Russell. And it looks like it should go higher, same pattern, strength, downward sloping consolidation, reversal, and now, up near some resistance. And just mark your reference point. You can use the same one here of Thursday's low being a short-term reference point. You've got unfilled gaps here. You got the 200 just below. You've got this minor support. So all of these things in a general area. You should always look at support and resistance as general areas versus the fib level traders or that look to pinpoint things within a fractional decimal point of where things should turn around. That is what real traders do. They just know that, hey, if I'm in an area, just now look for buyers to take control or sellers to take control. Dow continuing to move up, as again, all-time high should happen with a pattern like this. I mean, if they don't, by, I would say, the following week from now, maybe something's wrong. Because this pattern says it's going to go up there and make new all-time highs. So futures, just taking a look, we looked at oil. Gold is up here nicely. It's held that low, which is what we were looking to see if it could do that last week. And it's moving up here this morning. I don't know how much more could be left in the move, but note the tail here, meaning that attempt to go down, that bottoming tail that took out the low and sprung back up. That said that there were big buyers lurking below, just waiting for it to come down here. While this was still in the bottom part of that wide range bar, this was a bullish sign to break down like that and then come right back up again. Bonds down a little bit, really no big deal in relation to what happened on Friday. So we'll see where that goes. It was a pretty big move up, and that brought in the concerns of an inverted yield curve. So we'll see if this can just stabilize here. That would be supportive of the market as well. And our internals tell us, keep an eye on the exit door here. So it doesn't mean the markets can't run higher. It's what these patterns say that they're good or to what they should do, I should say. But breadth is starting to become at a bearish extreme. And sentiment just never waned from the sell signal back here, rather than prices chopping up and pulling back, sentiment never backed off very much, other than maybe on a day-to-day basis intraday. And that's a bit of a concern that, this bullish sentiment, which is actually bearish because it reaches an extreme here, as it did right there, right up to that 0.80 level. There was never a concern, so to speak, that this market wasn't going to go higher. And what we like to see during uptrends is a concern, a worry, and, sentiment get to a bullish level. And then, that's supportive of a uptrend that can continue over an extended period of time. So how much higher can they go? Well, if they get through the all-time highs, well, that's a void and nobody really knows. But one of the things to look at, which I'll show you, which I shared with subscribers over the weekend in the ETF letter, where we look at a whole bunch of ETFs, was, let's just look at historical reference points and see, as compared to what's happened in the past, what would be normal? Well, these are just some of the ETFs that are followed in what we call a matrix that I report on the trends in multiple time frames. And we see, and I was a little surprised when I actually looked at this and sorted it, that it was solar that has been the best performing sector year to date. There's only like one stock in that whole sector or two that have any kind of volume. But in any event, and most of these made their moves at the beginning of the year, and then they chopped around. So 33%, biotech, almost 31%, semiconductors, which have been doing really well and look like they can go higher, almost 30%, software, right? So you can see the grouping of technology, over 20%, and the Qs there, a mix of those, almost 20%, so on and so on. Even the Russell that looks the worst, almost 18%. So, based on all of that and saying, well, hey, these markets have been up 30, 20%, 15%, and we're at the beginning of April. Are they going to double from here? Historically, we would say no. That's unlikely, and this is going to be some kind of an amazing, market, and we can't assume that. So my assumption is based on historical reference points is that the upside, while new all-time highs look like a probability, beyond that, it seems less likely that they're going to be up, let's say 50% or 60%. So we just want to keep that in mind and be objective and just follow what is. And so with that in mind, we still go back to the same factory work. Where's our first reference point of support? Where's minor support? Where's major support? How deeply did prices retrace? What are our internals saying? So it just becomes our method, or a systematic method of monitoring the concepts and that we do to create a bias. Well, everything is bullish at varying degree. I mean, gold has been the least, Tony, as you can see, it barely up. It, even though it made a big move, it came down a lot. So the gold miners, on the other hand, have outperformed quite a bit. So being in gold, right, didn't help you very much. But, if you'd recognize the beginning of moves in gold, well, the miners, they did well. But compared to technology, it certainly wasn't the place to be. But you could have done a little bit in there. TBT, which is short bonds, is the problem here, because if this was holding and started to move up and then broke down, and that is where the whole yield curve, right, problem occurs from. Back earlier in the year, where managers started saying, hey, this is possibility, and the correction started, and now the shortest yields have already inverted, and now with the back off in bonds and rise in yields last week, that's backed off from the inversion here, the 3-month versus the 10-year. This is the 5-year versus the 10-year. They backed off, and this is the longest, the 3-month versus the 30-year, have backed off from moving toward that inversion level, which is supportive of the markets making new all-time highs. So we're in a bit of a strange situation this year. Market environments are always changing, and that's why you can't rely on, say, a red light, green light system, or, some indicator that's like, the most wonderful thing that is producing money. And maybe it is in the moment, but once the markets change, where you go to look at a different market or stock, that thing, you can throw it out the window the majority of time. So we look at a combination of objective data that's about price action, market internals, intermarket analysis, what I refer to as techno fundamentals, or the three-legged stools of the market, rather than looking at those holy grail indicators to guide us as to what our bias is. And then ultimately, it just comes back down to price action. Is it going up, down, or sideways? And where's your next reference point? So that's it from me. I'll turn it over to Dan. I hope that helps you during the week here, and just follow what we've been saying, and we'll be here. We'll be here all day. Videos on YouTube. We'll be here tomorrow morning, and don't forget MT Live on Wednesday.
Good morning, all, and MT Live. We're going to be talking about trading news, objectively, of course. Tony asking about Fizzler, power trend into the void. What void are you talking about? It's been on a power move here, greater than 100% retracement off this prior low. It's in an uptrend, higher pivot highs, lows, rising 20, 50. Looks higher on the monthly. All right, opens. CGC, pot stock, we still have our call spread. Fizzler, we're short, not Fizzler. Tilray, another pot stock, gapping down here. We legged into a covered put, the out of the money 58. So, see, we're kind of capping our gains, but we did it at a very nice premium. So no adjustments as of now. That looks great. PCH, we're long stock. Got into that on the bullish daily weekly on Friday. AMT was a watch as a 1, 2, 3 short right here, but in the comments I canceled it because it's just acting too strong, even though it is extended. I'll still keep an eye on it though. Zawo, we have a covered call, looks great. Can even add over Thursday's high. Triple M, ooh, hope that gap down is not real. We have a covered call. Also, keep an eye on that at the open. ACIA, we have a covered call. AMAT, covered call. So you see these covered calls we leg into them. Inside here, we have a short call spread. Allstate, we're long stock. It shows a gap down, but there's no volume, so I can't trust it. Calm, we're not in, but over Friday's high, it looks good. T2, it's our only open position in the weekly options trader, but we had an active week. We closed 9 trades, 9 out of 9. We batted 100% in our weekly options trader. RTN, we're short stock. This was like our only problem child in the advisory swing letter because of the deep retracement. And it looks like it's gapping down a little bit here. Oh, on George, on monthly, okay. Yeah, no, monthly, yeah, well, I'll come back to it. FTI, we bought Friday into the close, oil stock. OIS is on my watch list here. We had a lot, we did Friday afternoon scanning, found a lot of good stuff. Abco here is a new trade put spread, MTG. We bought this Friday into the close. Looks good. FCX is a 123 over Friday's high. CNDT is a new trade. Look bullish. Daily, weekly looks great. Peggy, little oil stock over the high. XOM oil looks higher. XOP, the ETFs look higher. OIH over the high. XL, some of these we're going to be doing directionals and put spreads. A lot of activity there. iRobot, we like as a put spread. AIG is still a watch. We'll see how it stabilizes on this pullback. I think I got them all now. Capra here is a cannabis stock over the high. All right, I'll get back to Fizzler. Yeah, no, it's been in a multi-year trading range after this shellacking. Wow, look at that thing. Used to be over 300 bucks. Wow, I didn't remember that. Yeah, we might, you know what? This might be a core trade for us. I'm gonna watch it on a pullback. I like it. I like it. And that's how we use multiple time frames. Gappers here. We got a couple minutes. We dodged a bullet on this Boeing. We were, we've been trading it fairly aggressively, and I've always given the note higher risk because, it's gappy with all the bad news surrounding its 737 MAX. And look at this 15 or the hourly chart. I did not like this action into the close Friday, cracking this horizontal support. And I said that we were up like a dime or something like that. And I said, close it out. And we dodged a bullet. Whether you trade options or stocks, you can't avoid gap risk if you're a swing trader. All you can do is structure the trade and, in the product that you trade with volatility or ETFs to try to minimize the gap risk. But, now it's damaged. It's a Bear Island reversal now. I'm gonna stay away from this thing, and also it's cutting its earnings. And when you've had such a stellar stock for so long, give an earnings cut